is an analysis report on SIDU's space, SIDU, is focused on that huge potential $151 billion MDA contract announcement and the volatility that followed from the stock offering.
Right. And the core argument seems to be that this is a major contrarian opportunity, that the dip to around $1.50 is, a golden entry point because of the contract.
Exactly. But that brings us to our first point.
It does. I wonder how the, let's say, high-energy delivery here might land with a more sophisticated investor who's really looking to do their due diligence. The presentation style needs immediate attention.
So let's start there, tempering the tone to enhance the analytical credibility.
The report uses some really aggressive, emotionally charged language, and I think that undermines the objective, data-driven nature of good financial analysis.
I see what you mean. I'm looking at the headline, Rocket SIDU explodes plus 97%, and then it calls the rise absolutely parabolic, and the sell-off an after-hours bloodbath.
Exactly. And that's the weakness. Using terms like that risks positioning the whole thing as, sensational rather than sober. For a microcap stock this volatile, credibility is everything. You have to balance the excitement with a really detached assessment of the risk.
But let me push back on that for a second. For this kind of stock, a high-risk, high-reward play, don't you almost need that aggressive tone to get people's attention and build conviction quickly?
That's a fair question. But the goal isn't to kill the conviction. It's to replace the emotional hype with, quantitative urgency.
Okay.
So the suggestion for improvement is to let the data create the excitement. I mean, the sheer size of the $151 billion IDIQ ceiling against a company with only $3.6 million in revenue, that's the drama right there. You don't need the adjectives.
So you're saying shift the focus from the analyst's reaction to the market's overreaction.
Precisely. Let's make it concrete. Instead of saying something like, Wall Street might be wrong, which is just adversarial.
Right.
You could rephrase it. Something like, this price movement suggests an overreaction to short-term dilution, creating a significant deviation from the company's implied valuation. It's analytical, it's not emotional.
And it gives the reader a thesis they can actually test, instead of just an opinion to agree or disagree with. I like that.
And another example, the conclusion. Instead of volatility is the price you pay for performance, which is a bit of a cliche,
A little bit, yeah.
frame it as a direct risk-reward calculation. Maybe something like, given the potential impact of even a 5% allocation of the contract ceiling, the current valuation provides a superior risk-reward ratio if key technical support holds at 150.
That's so much more actionable. It's grounded in a specific number and a specific outcome.
It's a huge jump in sophistication. But okay, if we're going to use a professional tone, the logic has to be just as rigorous.
Which brings us to the next point. That massive $151 billion number.
Yes, we need to strengthen the contract's relevance by quantifying some scenario probabilities.
So the material makes a strong case that this contract is a game changer. It says even a small slice, maybe $50 million, would be transformational for a company this size.
And it would be. That makes sense. But focusing only on that giant ceiling might overlook the reality of how these IDIQ contracts actually work, right?
That's the core weakness here, isn't it? The analysis explains what an IDIQ is, but then it just jumps to projecting these huge wins like they're a sure thing.
Exactly. It treats a $50 or $100 million win as a baseline, but without any real support for that assumption. The reader sees the huge number, but they don't see the bridge from that number to SIDU specifically. How does their tech translate to a quantifiable chance of winning these task orders?
So the job of the analysis is to build that bridge, to get from the theoretical max to a modeled expected outcome.
That's it. So the suggestion here is to bolster the analysis by mapping out a few expected revenue scenarios, connect the slice of the pie to their operational capacity, and, just as importantly, the timeline.
Right, because $100 million over 10 years is very different from $100 million over 2.
Very different. An investor needs to be able to amortize that revenue. So for a concrete example, the report needs to add a short sensitivity analysis section. It doesn't have to be exhaustive, just representative.
So like a best case, worst case, base case?
Sort of. Start with a low probability scenario. Let's call it Scenario 1. SIDU secures, say, 0.01% of the total vehicle. That's about $15 million in task orders. The analysis then has to ask, how does that affect the 10x potential? Is the stock still a buy at $1.50? That sets the floor.
Okay. So that establishes the downside protection in the thesis.
And then you follow it up with your more optimistic, but still grounded, target.
Scenario 2. SIDU gets that $50 million. But what's the time frame? 3 to 5 years? Okay, so that's $10 to $16 million in annual revenue. Now the reader can apply their own multiple to that. It becomes a real model.
What if that kind of historical data on MDA contracts isn't available? What should the analysis do then?
Good question. You pivot. If you can't compare it to past contracts, compare it to the other companies who won a spot on this one.
Ah, the competitive landscape.
Right. If SIDU is one of 20 prime contractors, how do they stack up? Where are they on technology, on manufacturing scale? That provides context for that $50 million target. It moves the analysis from just wishful thinking to, an actual probability.
That kind of comparative work immediately builds confidence. It shows rigor.
And that rigor is what replaces the hyperbole we talked about at the start. It shifts the entire conversation.
And that rigor needs to carry through to the final point, which is about the dilution. The report argues that the after-hours drop was just retail panic, but that the cash raise is actually growth capital needed to fulfill contracts.
I really appreciate that contrarian take. It's often true for these small caps. But you have to establish the financial justification for calling it that.
Because without the numbers, it's just a nice story. A skeptical investor will just assume they're funding their existing cash burn.
And that is the weakness here. The idea is persuasive, but it lacks the financial modeling to be robust. The report mentions they have about $12.7 million in cash, but it doesn't quantify the dilution from the new offering.
So the reader is left guessing about the real downside. And maybe more importantly, they're wondering if this is just the first of many dilutive rounds to come.
An experienced investor is always thinking 2 or 3 funding rounds ahead. So the suggestion is to include a brief projected capitalization table analysis.
Show your work.
Exactly. Don't hide the dilution. Own it. And then explain precisely why it's a net positive. Translate it into a clear cost-benefit ratio for the reader.
Okay, so let's make that actionable. What would that look like?
Well, for a concrete example, first you quantify the cost. You estimate the new cash raised. Let's say it's $5 million at $1.50 a share. That's 3.33 million new shares. So you explicitly state the dilution is maybe, 8 to 10%. That's the cost.
And then you immediately pivot to the benefit.
Immediately, you connect the new pro forma cash balance. So the old cash plus the new offering, maybe $17.7 million total, to a projected burn rate required for these new contracts. You show that the short-term cost is funding a long-term asset.
It completely closes the loop. It reframes the whole narrative from bad dilution to necessary investment.
And you could end that section with a really specific statement, something like, the estimated 17.7M cash runway provides 18 months of capital at the anticipated ramp-up rate needed to service a $50 million contract, confirming its status as true growth capital.
That kind of specificity it takes the analysis from an opinion to a real financial argument. Any professional would respect that. It takes the emotion out of it.
Which is critical for a stock this volatile. You're using the company's own fundraising as evidence for the thesis. It's a powerful argument, but only if you justify it financially.